Think General Motors is just about cars, right? You know, trucks, SUVs, maybe some classic muscle.
Yeah, the familiar stuff.
But what if we told you that underneath that familiar automotive giant, there's a whole world of advanced tech, global trade complexities, even unexpected ventures into AI data centers shaping its future? It's far more intricate than just what rolls off the assembly line.
Absolutely. It's a massive, complex operation.
Today, we're embarking on a deep dive into General Motors' second quarter 2025 earnings. They were just released today, July 22nd, 2025.
Fresh off the press.
And this isn't just about crunching financial numbers. It's really about decoding how a legacy automaker, a true titan, is navigating a landscape that's, well, changing at warp speed.
That's right. And to give you the inside track, we've pulled key insights directly from GM's Q2 2025 earnings call transcript and their official press release.
Right.
Our mission today is to distill the core strengths, the significant challenges they're facing head-on, and the strategic plays GM is making right now to secure its long-term future.
So you'll walk away with the critical nuggets, really feeling well-informed.
Exactly.
Okay, let's unpack this with the big picture first. GM's financial snapshot for Q2 2025. The numbers show total revenue for the quarter at $47.1 billion.
Which is actually down a bit.
Yeah. It's a slight dip, down 1.8% year over year from nearly $48 billion. And net income attributable to stockholders also saw a significant plunge, drop to $1.9 billion.
Wow, that's a big drop.
Yeah, a substantial 35.4% decline from over $2.9 billion last year.
And if we look at other key metrics like EBIT-adjusted, their core operating profit.
Right, EBIT-adjusted.
That was down 31.6% to $3.0 billion. And their diluted adjusted EPS, earnings per share, also down about 17.3% to $2.53.
So quite a few numbers heading downwards year over year.
Definitely. But, and this is important, while those year-over-year declines might look stark, what's truly noteworthy here is that despite these considerable headwinds, GM's full-year financial guidance remains completely unchanged.
Unchanged after those Q2 numbers.
Unchanged. Which signals, I think, a remarkable confidence in their ability to course correct in the second half of the year.
Okay, so why the declines in Q2 then? The sources point to two main things, right? Tariffs and warranty charges.
Exactly. A significant net tariff impact and increased warranty-related charges were the primary drivers.
But it wasn't all bad news.
No. Those negatives were somewhat offset by lower fixed costs,
Right.
improved product mix, meaning selling more profitable vehicles, and some favorable foreign currency impacts.
Okay.
All that helped cushion the blow a bit. It really highlights the incredibly multifaceted nature of running a global auto business these days.
Right. So moving from the overall numbers, let's zero in on one of those major headwinds, that tariff maze you mentioned.
Yeah, this is a big one.
They got hit with a substantial net tariff impact of about $1.1 billion just in Q2.
$1.1 billion. In 3 months, that's a massive amount of money to absorb.
And it's not over, is it?
No, it's not a one-time event. GM anticipates an additional quarter of this net tariff impact in the second half.
Yeah.
They're expecting about another $1 billion hit to their EBIT-adjusted landing, mostly in Q3 and Q4.
And Q3 could be worse than Q2?
Yeah, they actually flagged that Q3 net tariff costs are likely to be higher than Q2, just due to the timing of how some indirect costs get recognized.
So for the full year 2025, what's the total expected hit?
GM is projecting a gross tariff impact before any offsets of a staggering $4 billion to $5 billion.
$4 to $5 billion. That's a formidable challenge for any company. So what are they actually doing to counter this? How do you fight that?
Well, that really begs the question, doesn't it? How do you mitigate something that large?
Yeah.
GM is aggressively working to offset at least 30% of that $4 or $5 billion challenge.
Okay, 30%. How?
They've broken it down into 3 key action areas, each contributing roughly a third of that offset.
Right.
So first, significant manufacturing adjustments. Think rerouting components, maybe bringing some production changes to different plants.
Yeah.
Second, targeted cost initiatives across the whole business. Finding efficiencies, leaner logistics, optimizing factory operations, cutting costs where they can without hurting the product.
And the third?
Disciplined, consistent pricing for their vehicles. They're basically holding firm on prices, trusting the value of their product rather than resorting to heavy discounts, even in this tough market.
But I noticed they're still importing vehicles even with these tariffs from places like Canada, Mexico, and Korea. Why keep doing that if it costs so much?
That's a good question. They're doing it strategically. primarily to avoid interrupting supply to customers and make sure vehicles are available on dealer lots.
Ah, so keeping customers happy.
Exactly. And even with the tariffs, these imported vehicles are still what they call contribution margin positive,
Meaning?
meaning they still make enough profit on each one to cover the direct costs of making and shipping them, plus the tariff cost. Customer demand is strong enough to support that price point.
Got it. Okay, so this ongoing need to import, even with tariffs, that links directly to GM's bigger, longer-term play for tariff reduction, right? This new investment.
Precisely. This is where they're making a truly strategic move. GM announced a new $4 billion investment in U.S. assembly plants.
$4 billion. Now, is that all new money or?
Not entirely. They mentioned it isn't all incremental capital. A portion is offset by finding operational efficiencies elsewhere. But the impact is huge. It'll add 300,000 units of U.S. capacity.
300,000 more vehicles built here. For which models?
For their most profitable ones. High-margin light-duty pickups, full-size SUVs, and crossovers.
And how soon does this capacity come online?
This is key. It starts coming online in just 18 months.
That's quite fast.
It is. And it projects them building over 2 million vehicles right here in the U.S. annually once it's fully ramped up.
Which will drastically cut their tariff exposure.
Exactly. And crucially, it helps satisfy unmet demand for these popular vehicles. They gave some examples. Cadillac Escalade production will shift to their Orion assembly plant. They're tooling up for next-gen full-size light-duty pickups.
What else?
They're adding Chevrolet Equinox ICE production at Fairfax Assembly and moving Blazer ICE production to Spring Hill.
Ah, shuffling things around.
Right. Smart moves to both reduce tariff exposure and increase the utilization of their existing U.S. factories.
So it really sounds like they're building in a lot of resilience, preparing for worst-case scenarios with tariffs, as they put it.
That's a fair assessment. They're preparing for the toughest scenarios, which interestingly suggests there's potential for upside if things improve, like if new bilateral trade deals emerge between the U.S. and these other countries.
Right. Their guidance assumes the worst, so any improvement is a bonus.
Exactly. Their current guidance factors in the known pain, but any positive shifts in trade policy could provide an additional boost later on.
Okay, so we've covered the financials and the tariff battle, but GM's story isn't just about weathering storms. It's also about their dual-engine strategy pushing ahead with both traditional ICE vehicles, internal combustion engines, and EVs.
That's right. And despite all the buzz around EVs, GM is still showing immense strength in its traditional ICE portfolio.
How strong?
Well, they've outperformed the market significantly in ICE. GM gained total market share, fleet share, and retail market share year over year, and also from Q1 to Q2.
Impressive.
Their U.S. market share hit 17.3% in the first half of the year. That's up 1.2 percentage points year over year.
And what's driving that? Specific models.
What's truly compelling here is the success of their crossover portfolio. It delivered record results and saw really strong demand. The Chevrolet Equinox, for example.
Yeah.
It gained nearly 6 points of retail market share year over year in the industry's biggest segment. And demand is strong for both the ICE version and the new EV model.
Wow. 6 points is huge in that segment. And they did this without heavy discounts, you mentioned.
That's another key point.
Yeah.
GM's incentives stayed well below the industry average, and their pricing has been relatively consistent.
Which really demonstrates underlying product strength, right? Not just buying market share.
Exactly. It speaks to a robust product lineup and a disciplined production strategy. It's not just about moving metal, it's about building brand value and customer loyalty. That's a much healthier long-term approach.
Okay, let's switch gears to the EV side then. It's a rapidly evolving and, frankly, increasingly crowded market.
Very crowded.
GM acknowledges the EV industry growth has slowed compared to maybe what people expected a year or two ago, but they're sticking to their guns.
They are. They reiterated their belief in profitable, long-term EV production as their North Star, as they call it.
Right.
That's a crucial point for understanding their long-term vision.
And how are they doing in this crowded field?
Well, think about it. 5 years ago, there was basically one major EV player. Today, there are over 30 competing.
30?
Yeah. Despite that fierce competition, Chevrolet has climbed to become the #2 EV brand in the U.S.
Number 2. Wow. Driven by which models mainly?
Largely thanks to the popularity of the Blazer EV and the Equinox EV hitting the market.
And Cadillac.
Cadillac has become the #5 EV brand overall, and notably the leader in the luxury EV space.
Leader in luxury EV?
Yep, fueled by the launch of the Escalade IQ and really impressive conquest rates,
Conquest rates, meaning?
meaning they're pulling customers away from other brands, over 75% for the Lyric, and approaching 80% for the new Optic. That's
Yeah.
very strong.
Okay, so with all that competition, what's GM's actual strategy for making EVs profitable in this tough landscape?
Good question. Their investments are strategically shifting toward improving that EV profitability. It's less about just volume now and more about margin.
How are they doing that?
It means relentless work to drive down costs.
Yeah.
Things like making vehicles lighter and more aerodynamic so they get more range from smaller, cheaper batteries,
Makes sense.
and standardizing key components like electric motors across different models to get economies of scale and reduce complexity.
And what about the batteries themselves? That's such a critical piece of the EV puzzle and a very complex one.
Definitely. A key takeaway here is their multi-pronged battery approach. It's
Yeah.
not just one solution.
Okay.
Their Ultium cell plant in Indiana is producing prismatic cells. These are known for being cost-efficient and durable, especially in larger vehicle packs like trucks and SUVs.
Prismatic cells. Got it.
Then, by late 2027, their joint venture plant, Ultium Cells Spring Hill in Tennessee, will also start producing LFP cells, lithium iron phosphate.
LFP. Right. We hear a lot about those.
Yeah, and they developed those with their Korean partner, LG Energy Solution. LFP cells are known for lower cost and enhanced safety, making them great for certain applications, maybe more entry-level EVs.
So prismatic and LFP. Anything else?
Yes, and this is potentially really interesting. They're also developing a new chemistry with LGES called lithium manganese rich, or LMR.
LMR. Haven't heard as much about that one.
They're calling it a potential game changer. It's hailed for its unique balance, high energy density, which means good range, fast charging capability, and significant cost efficiency because it uses less of the expensive materials like nickel and cobalt.
Less nickel and cobalt. That's key for cost.
Huge. They actually think the potential cost savings from LMR and large truck battery packs might even be greater than using LSP, at least based on today's metal prices.
That sounds like a really powerful combination of battery technologies then. Are they seeing new business opportunities pop up from all this deep battery expertise?
Yeah, this really begs the question about leveraging these assets beyond just putting them in cars, right?
Right.
And yes, they are. First, GM's used EV batteries. Second life batteries are being repurposed by Redwood Materials, which extends their useful life.
Sustainable.
Exactly.
Right.
But also, GM is finalizing an agreement to supply new battery modules to Redwood Energy, which is Redwood's new energy storage business,
For what purpose?
specifically to meet the surging power demand for AI data centers and other large-scale grid storage applications.
Wow. Okay, so GM batteries powering AI data centers. That's not what you typically think of.
It's a clear diversification play. It shows how GM is really becoming a broader energy technology player, not just an automaker. And crucially, all the cells built by their joint ventures qualify for those advanced technology manufacturing tax credits under the Inflation Reduction Act.
Which helps the bottom line.
Absolutely. Further reduces costs and makes these ventures more attractive.
Now, another piece of the EV puzzle is charging infrastructure. Access to chargers is still a big concern for many potential buyers. What's GM's progress there?
They highlighted significant expansion. Their own GM Energy, 350 kilowatt chargers, are now operational at nearly 200 pilot travel centers,
Shops, yeah.
primarily along major interstate corridors like I-75 between Michigan and Florida. They said the stations are typically no more than 150 miles apart.
Okay, filling in the gaps on highways.
Right. Plus, the first chargers from Iona, that's the multi-automaker charging joint venture GM, is part of those 400 kilowatt stations, are now in service in multiple states too.
So multiple efforts underway. What are their overall goals for charger numbers?
They have ambitious goals. They're targeting 65,000 public fast charging bays available to their customers by the end of this year.
65,000.
Then 80,000 by the end of next year, 2026, and 100,000 by the end of 2027.
So over a 50% increase in just 3 years.
Yeah, it shows a serious commitment to building out that infrastructure access.
And underpinning all of this, both IC and EV, is manufacturing flexibility. That sounds absolutely crucial in today's unpredictable market.
It absolutely is.
Yeah.
GM is intentionally building flexibility into its plants, like Spring Hill and Fairfax we mentioned earlier.
How does that work?
They can adjust the production mix between ICE and EV models based on how market demand shifts. If EV demand slows down unexpectedly, They can absorb some of those manufacturing costs by building more popular ICE vehicles in the same facility.
Ah, so they're not betting the whole farm on one type of vehicle in any given plant.
Exactly. It's an inherent advantage, a strategic hedge that positions them incredibly well in a volatile market compared to maybe some EV-only startups.
Okay, let's shift focus again. Beyond the physical car, GM is really trying to supercharge its business with software and services. Super Cruise seems like a big part of this.
It's definitely a significant growth area. Super Cruise, their hands-free driver assistance tech.
Right.
It's now offered on 23 different models, and they keep adding new capabilities. They're on track to have over 600,000 customers using it by the end of this year.
And these customers pay for it.
Yes, each one has paid up front for 3 years of service when they bought the car, and adoption is strong and impressive in Cadid. 70% of new Cadillacs delivered are now equipped with Super Cruise.
70% of Cadillacs. Wow. And what about OnStar? That's been around for ages.
It has, but a key takeaway here is how they've changed their approach. They now price vehicles to include a period of basic OnStar services right from the start.
Bundling it in.
Right, and that's driving record subscriber rates. It also increases their direct engagement with customers throughout the vehicle's life, moving OnStar from maybe an optional add-on to a core part of the ownership experience.
This engagement, this software focus, it's clearly paying off financially too, right? They mentioned deferred revenue.
That's right. GM has already booked $4 billion in deferred revenue just from Super Cruise, OnStar, and other software services.
$4 billion they'll recognize over time.
Exactly. And their projected revenue just from Super Cruise alone will be over $200 million this year, 2025.
Okay.
And they expect that to more than double in 2026. They're anticipating robust, double-digit compound annual growth for software revenue right through the end of the decade.
That's a powerful, high-margin revenue stream they're building.
Definitely. Very different from just selling the car once.
They also rolled out a new loyalty program, My GM Rewards. What's the angle there?
This is their new and improved loyalty program combined with a credit card portfolio.
Yeah.
It offers members more savings, but also exclusive access to experiences.
Like what?
Things like trackside access at racing events or unique off-the-grid EV driving excursions. They invest in these because loyalty members are incredibly valuable. Well, the data shows these members tend to buy higher MSRP vehicles, and perhaps more importantly, they visit GM dealers for service at nearly twice the rate of non-members.
Ah, so it drives service revenue too.
Exactly. It's
Yeah.
a smart way to increase customer lifetime value and keep them within the GM ecosystem.
Okay, let's address another headwind we touched on earlier.
Yeah.
Quality and those warranty issues. GM acknowledged a $300 million increase in warranty expenses in Q2 compared to last year. What exactly caused that bump?
Yeah, they were upfront about that. The increase was mainly due to two things, what they called L87 issues, which relates to specific V8 engine components.
Okay, an engine issue.
Right. And also some software glitches on some of their early EV launches, which isn't entirely unexpected with new complex platforms, but still needs addressing.
So what proactive steps are they taking? How are they addressing these issues head on and, putting customers first?
They emphasize that they are facing these challenges directly. Their top priority is the customer providing extended warranties in some cases, and crucially, shifting component supply towards their after-sales network to ensure faster repairs for affected vehicles.
Getting parts to dealers faster?
Right. But that begs the question about tackling the root causes, right?
Yeah.
To prevent these things from happening again.
Exactly. What are those root causes and what's GM doing to solve them for the long term?
They're pursuing multiple paths here. One is working closely with suppliers to improve quality across the board, with increased engagement on critical component operations to make sure everything meets high standards before it gets to the assembly line.
Makes sense. What about the software side?
On software, they said spending on software-related issues on a per-vehicle basis is actually down roughly 25% year over year on their most recently built vehicles.
Oh, that's a positive trend. Why the improvement?
It's thanks to a few things. Expanded use of over-the-air updates to fix bugs remotely,
OTA updates, right?
a lower number of incidents per vehicle being reported, and generally more robust infotainment system updates being pushed out. They're also leveraging enhanced diagnostics and developing new prognostic tools.
Prognostic tool.
Yeah, tools that can predict potential failures before they happen, allowing them to identify issues sooner, develop repair procedures faster, and minimize unnecessary repairs or repeat visits for the customer.
Interesting. Anything else on the quality front?
They also mentioned complexity reduction efforts. They're winning with simplicity initiatives.
Mm-hmm.
Basically, designing vehicles with fewer unique parts and more streamlined systems is helping support improved launch quality, like they saw in the recent Tahoe and Yukon launches.
So, bringing it all together, they expect warranty costs to stabilize.
Yes, they expect those costs to stabilize in the second half of the year, which is definitely a key indicator investors will be watching closely.
Okay, finally, let's look briefly at GM's global reach and their future vision. GM International, or GMI, had a good quarter.
Yeah, GMI delivered $200 million in EBIT-adjusted in Q2. That's up a solid $150 million year over year.
And what specifically drove that improvement?
This was primarily driven by improved profitability from their operations in China.
China. That's interesting given how competitive that market is, especially for foreign automakers.
Incredibly competitive. But GM was actually the only major foreign OEM to gain market share in China during the quarter. They also reported positive equity income from their Chinese joint ventures in Q2, with particularly strong performance in new energy vehicles, or NEVs.
Gaining share in China as a foreign brand is quite an achievement right now.
It really is. They sounded very proud of the team's execution over there and the competitiveness of their new products.
It sounds like overall they're really leaning into technology and bringing in top talent to drive this future vision forward.
They definitely are. They highlighted strengthening their leadership team with experienced tech executives. For instance, Sterling Anderson, who co-founded the autonomous trucking company Aurora, is now GM's chief product officer.
Ah, bringing in that AV expertise.
Right. And they are embracing AI across the entire enterprise. They brought in Barak Tureski, a veteran from Google and Cisco, to lead these AI efforts.
Under whom?
He reports to Dave Richardson, who heads up software and services engineering, and is himself an Apple veteran. So serious tech leadership there.
And what does embracing AI mean for GM in practice?
Well, they said this team isn't just installing AI tools here and there. They're looking to redefine how intelligence powers basically every facet of GM.
Like what?
From optimizing vehicle performance in real time using sensor data to personalizing the customer experience through their infotainment systems and even streamlining operational excellence on the factory floor for greater efficiency and quality control.
So AI is becoming deeply integrated.
That's the plan.
Okay, so despite the quarter's headwinds, particularly tariffs and warranty costs, GM has confirmed its full-year outlook.
Correct. They reiterated their guidance. Full-year EBIT-adjusted is still expected between $10 billion and $12.5 billion.
And earnings per share.
Diluted adjusted EPS, which is their earnings per share after factoring everything in, is still guided between $8.25 and $10 per share. And adjusted automotive free cash flow between $7.5 billion and $10 billion. So no change to the annual targets.
But they did give some color on the second half versus the first half, right?
Yes, to help people understand the dynamics, they noted they expect EBIT adjusted in the second half of the year to be about $1.75 billion lower compared to the first half.
And why is that?
3 key factors they called out. First, that additional tariff impact we discussed, which hits mostly in H2. Second, typical seasonality, things like lower wholesale volumes in North America during the summer and the usual July plant shutdowns.
Okay.
And third, increased spending. They're ramping up investments related to preparing for the launch of their next-generation full-size trucks. Those are scheduled to start rolling out as model year 2027 vehicles, and also spending related to getting the Orion assembly plant ready for that new Escalade production.
Got it. Launch costs and investments. And quickly, what about shareholder returns? Are they still buying back stock?
They are. They confirmed they completed a $2 billion accelerated share repurchase, or ASR.
Which means?
It's basically a fast way for them to buy back a big chunk of their own stock. This latest one retired an additional 10 million shares. In total, under the current program, they've bought back 43 million shares.
That's quite a few shares off the market.
It is. It represents about a 4% reduction in shares outstanding just since the beginning of 2024, and a significant 15% reduction since Q2 of last year.
And are they done now?
No. They resumed open market share repurchases in early July, and they still have $4.3 billion remaining on their current buyback authorization. So expect more buybacks to continue.
Okay, so wrapping this all up, what does this really mean for you, the listener? It seems GM isn't just, riding the waves of the auto industry. It's strategically adapting to them, sometimes navigating some pretty rough seas.
That seems fair. We've certainly seen their resilience today in dealing with those massive tariff impacts. We've seen their nuanced approach to the evolving EV market, not abandoning it, but focusing on profit while still dominating in ICE.
Right. And those proactive investments in software, in AI, in battery technology that really go far beyond just building cars.
Yeah, it's clear they're positioning themselves for a future where technology and that manufacturing flexibility we talked about are just as important as horsepower ever was.
Which leads to a final provocative thought,
Or
perhaps.
for it.
As GM deepens these ventures into things like battery storage for AI data centers and integrates advanced AI more deeply into its core operations, are we actually witnessing the transformation of an automotive giant into something much broader?
Like a diversified mobility and energy technology leader, perhaps?
Exactly. It makes you wonder what further innovations might emerge as they continue to blend that traditional manufacturing prowess they have with all this cutting-edge tech they're bringing in or developing.
That's the multi-billion-dollar question, isn't it? It'll be fascinating to watch how it unfolds.